Warren Buffett made billions during the 2008 crash. Michael Burry turned millions into billions during the housing collapse. Bill Ackman transformed $27 million into $2.6 billion during the COVID crash. What do these investors have in common? They all mastered one crucial psychological skill when the market was in free fall: controlling fear when others couldn't. Today's market downturn, with the S&P dropping 2.24% and the Nasdaq plunging 3.07%, is creating similar opportunities for those who understand that extreme fear in the markets isn't a disaster. It's a wealth transfer mechanism from the emotional to the disciplined. In this video, I'll show you exactly how to develop the psychological edge that lets you profit from panic rather than participate in it. Your time is valuable, so let's get right into it. First things first, being greedy when others are fearful is much easier said than done. The average investor loses 50% of their potential returns due to emotional decisions during market crashes. I won't let that happen to you. I'm not here to waste your time or hold you hostage, so here's exactly what you'll learn today. What exactly is causing the latest market downturn and why markets are falling today? Why the Fear and Greed Index just hit a shocking 16? And what this extreme reading tells us about coming market moves. The exact data patterns I use to spot maximum fear, moments that have delivered 50 to 80% returns in previous crashes. My battle-tested 5-step framework that's helped my viewers stay calm and profit during every market panic since 2020. And of course, the 5 specific undervalued stocks with the greatest upside potential right now. One is 79% below its fair value. Look, stock market falling today doesn't mean your financial future is in jeopardy. In fact, what I'm about to show you might make this the most profitable market crash of your investing career. Let's dive in. Stock markets around the world are falling as President Trump's tariffs take effect. Goods coming to the US from Canada and Mexico will now face 25% tariffs on most items, though some sectors like Canadian energy products have a reduced 10% tariff, and goods under USMCA remain duty-free. Chinese goods now face tariffs of up to 145%, on top of more specific ones like the 25% tariffs on Chinese steel and aluminum. Mexico, Canada, and China are still America's top 3 trading partners, but they now account for about 36.5% of all U.S. imports in 2024, down from 42% previously. Mexico, $505 billion. Canada, $421 billion. China, $462 billion. These Trump tariffs are creating significant market uncertainty. The S&P 500 has dropped 120.93 points, or 2.24% in a single day, closing at 5,275.70. The Dow Jones fell 699.57 points to 39,669.39, while the Nasdaq got hit hardest, dropping 516.01 points, or 3.07%. From their recent peaks, these indices are down significantly. The S&P 500 is now 14.13% below its February high, while the Nasdaq is down a whopping 19.17% from its December peak, verging on bear market territory. What makes this situation particularly volatile is the policy whiplash. Rapid announcements, temporary pauses, and subsequent escalations have injected profound uncertainty into the global economic outlook. The CBOE Volatility Index, VX, often called the Fear Index, has spiked above 30, signaling extreme investor anxiety. Unlike the 1929 crash or the COVID-19 plunge, which were sudden shocks, this downturn is developing more gradually as tariff news unfolds. On April 2nd, the administration unveiled its most sweeping measures: a baseline 10% universal tariff on nearly all global imports and higher reciprocal tariff rates up to 49% on numerous countries based on trade imbalances. These moves have market participants genuinely worried about a potential recession. The reason fear is the #1 psychological factor determining your success in market crashes becomes clear when we look at investor psychology. CNN's Fear and Greed Index, which tracks 7 key market indicators, is currently showing extreme fear. It's at 16, near 1-year lows. This means investors are panic selling, often at the worst possible time. One indicator I pay particular attention to within the Fear and Greed Index is safe haven demand, the difference in returns between stocks and bonds over the past 20 trading days. Currently, bonds are outperforming stocks by one of the biggest margins we've seen in years. This signals a massive flight from equities to supposedly safer assets. When extreme fear is driving the US market, investor behavior becomes predictable. People project current negative trends indefinitely into the future, abandoning long-term thinking for emotional reactions. This creates a feedback loop. Falling prices trigger fear, which causes selling, which pushes prices lower, triggering more fear. This is exactly what happened in previous crashes. In 1929, the initial panic led to cascading margin calls, forcing more selling. In 1987, Black Monday, computerized trading amplified the selling pressure. In 2000 to 2002, the dot-com crash saw psychology flip from greed to fear over many months. In 2008, the mortgage crisis triggered widespread panic about which banks would survive. In 2020, COVID fears caused the fastest bear market in history, with the S&P falling 34% in just weeks. In each case, those who controlled their fear, from Jesse Livermore to Warren Buffett in 2008 to Bill Ackman in 2020, made fortunes while others lost theirs. The difference wasn't luck, it was psychological discipline. Let's look at what the data tells us about the current situation. When we examine the last time investors moved this much money from stocks to bonds, July-August last year, we see a striking pattern. From July 15th to August 5th, the S&P 500 fell about 8%, its biggest decline over the last year before our current situation. But then from August 5th to August 30th, the index completely recovered before going up another 7%. Those who bought the S&P 500 at the bottom were up 17% by year-end. Individual stocks showed even more dramatic swings. Nvidia fell 22% during the panic, then gained 50% in the following months. Amazon dropped 16%, then rocketed up 50% afterward. The best thing any investor can do during a downturn is make moves based on data, not emotion. That's why I'm making this video. Looking at historical data on market crashes is not the same as living through one. For example, most of us would probably take the February 2020 crash over the one from 1929, since it took 15 times longer to hit the bottom. But in reality, the 2020 crash was much harder to hold through because the decline was so sudden and sharp. Looking at the current market, several stocks are showing similar disconnects between price drops and actual business impact. Broadcom, AVGO, is down around 20% despite revenues being up 25%, and earnings per share up a staggering 300% year-over-year. Nvidia, NVDA, has fallen 20% even though its revenues are up 78% and earnings up 84% from last year. Amazon, AMZN, is down 17% while its revenues are up 10% and earnings per share are up 84% over the last year. Discounted cash flow models now show Amazon as being 44% undervalued compared to analyst estimates, meaning the stock would need to rise 79% to hit its fair value. This kind of mispricing only happens when the stock market is crashing. Now that we understand what's happening, here's my practical framework for controlling fear during market crashes. Recognition. Acknowledge that fear is a natural response. Our brains are wired to avoid loss, and studies show the pain of losing money is psychologically twice as powerful as the pleasure of gaining the same amount. This is why stock market falling today feels so terrible. Perspective. Zoom out and look at the long-term data. Since 1929, the S&P 500 has had 21 bear markets, drops of 20% plus, but has always recovered and reached new highs. The average bear market lasts about 11 months, while bull markets last around 4.3 years and return much more than bears lose. Preparation. Have a plan before crashes happen. This includes maintaining a cash reserve, like Warren Buffett, who always has billions ready to deploy, and having a watch list of quality companies you'd love to own at lower prices. Controlled action. Make smaller, methodical investments rather than going all in at once. Dollar cost averaging into the market during downturns has historically outperformed trying to time the exact bottom. As studies show, even with perfect foresight of market bottoms, steady investing typically wins. Patience. Understand that recovery may take time. While some crashes like 2020 recovered quickly, others like 2000 to 2002 took years. The patience to hold through the recovery is just as important as the courage to buy during the crash. Most importantly, train yourself to see market crashes as opportunities, not disasters. As Warren Buffett famously says, "Be fearful when others are greedy, and greedy only when others are fearful." Right now, others are fearful, and the Fear and Greed Index confirms it. So what specific opportunities exist in this April 2025 market crash? Here are the stocks showing the biggest mismatch between price declines and business fundamentals. Broadcom, AVGO. A massive semiconductor company with AI software and hardware solutions, down 20% despite revenues up 25% and earnings per share up 300%. They make high-performance switches and network solutions for the biggest tech companies, and 99% of internet traffic touches at least one Broadcom device. NVIDIA, NVDA. The AI chip leader is down 20% despite 78% revenue growth and 84% earnings growth. With GTC, their developer conference, coming next week, there could be significant announcements not priced into the stock. Taiwan Semiconductor, TSM, makes 90% of advanced chips globally, including those for NVIDIA, Apple, and Tesla. The stock is down 20% on tariff concerns, yet revenues are up 39% and earnings per share up 57%. President Trump recently floated placing tariffs on computer chips made in Taiwan that could reach as high as 100%. Amazon, AMZN, down 17% while showing 10% revenue growth and 84% EPS growth. AWS generates more operating income than their online store and subscription services combined, and their advertising business is growing at 34% CAGR. Meta Platforms, Meta, and Google, both down around 20%, with Google's revenues up 12% and earnings up 31%, while Meta's revenues are up 21% with earnings growth of 51%. The key insight here is that when the Fear and Greed Index shows extreme fear, market participants often sell indiscriminately, creating bargains in quality companies. Just as in previous crashes, emotional selling creates opportunities for those who can control their fear. In my opinion, the foundation of every good long-term portfolio starts with a fund, especially if you're a newer or more emotional investor with itchy fingers. All the data that we've looked at so far tracks the S&P 500, but it applies just as much to the NASDAQ 100 because they're closely correlated. There are genuine risks to consider. The Trump tariff situation could escalate further, potentially triggering a recession if trade tensions worsen. Consumer sentiment has already plummeted, which could lead to reduced spending and corporate earnings. Rising prices thanks to tariffs might mean lower consumer spending, which leads to lower earnings and ultimately lower stock prices. However, historical data shows that even in worst-case scenarios, markets eventually recover. After the 1929 crash, the 2000 tech bubble, and the 2008 financial crisis, markets not only recovered but went on to reach new highs. The biggest risk isn't a temporary market decline. It's letting fear drive your decisions, causing you to sell at the bottom or miss the recovery. As the data shows, missing just the 10 best days in the market over a decade can cut your returns in half. If you found this analysis helpful and want more insights on how to navigate the stock market falling today, hit the like button and subscribe to the channel. Your engagement lets me know to produce more content like this during these volatile market periods. The current market downturn, driven by Trump tariffs and extreme fear, is creating significant opportunities for those who can maintain psychological discipline. While the S&P 500 is down 14% and the NASDAQ nearly 20%, quality companies with strong fundamentals are trading at substantial discounts. The Fear and Greed Index shows we're at levels of extreme fear that have historically marked excellent buying opportunities. By focusing on companies with strong growth despite market turbulence, investors with the right psychological approach can position themselves for substantial gains when sentiment improves. Remember, millionaires are made during stock market downturns, but only by those who control their fear and make rational decisions based on data, not emotion.